Okay. So order block and imbalance. So that's what I'm going to get through with us today. So we will see how far we can go, so we can get through it in a minute. So before I go further, let me quickly touch something on the market structure and relate to order block and imbalance. You might have something like this in the market. Let me go with this. Okay. If you have something like this in the market, maybe let's say this is a bullish trend. Being a bullish trend, look at where our concern is actually based. Our concern should be at the higher low, and a higher low. If you invert this very structure, meaning in a bearish trend, this way, our concern should be in a bearish trend this way. Our concern should be this lower high and lower high. Now, when the moment the market gets into this lower high or higher low and reverses, it's called mitigation. Yes. The moment the market returns to a zone and reverses, it is called mitigation. And if market has not returned to a freshly created zone, let me say, if this is a zone freshly created, the market went this way. Okay, as far as the market has not returned to this very zone, we'll make reference to this zone as unmitigated. We'll say it's unmitigated. So as far as market price has not returned into the zone, we'll make reference to it as unmitigated. Then the moment the market gets back into it and travels up, but we'll say the zone has been mitigated. What's wrong with my cursor now? Excuse a minute, let me just clear this. I'm coming. Don't really know. Okay. So the moment in a freshly created zone, something of this nature, we will say this point, the market is already mitigated because the market has stepped into it. But this very one is unmitigated because the market hasn't stepped into it yet. So this is already mitigated. Why? They've taken off the others left there. This is mitigated. And for this one, we'll say this one is unmitigated, meaning the market has not stepped into it to pick up the orders resting on this very zone. Now, that is actually what's going to bring us to the business of the day, which is order block and imbalance. I'm not going to actually go deep into market structure because I think to some extent I've done some basic justice to market structure. That's why I'm still going to help. I'm still going to have some. I'll give you a link to the videos so you go through it. But let me face order block and market structure. When something like this happens, we'll say there is a break of structure here. Okay. There is a break of structure here. And there is another break of structure here. Now, this break of structure, let me just label it. We'll call it the BOS. The break of structure is used when the market is continuing the trend. But when the market reverses from the trend, we make reference to it as a change of character or break, just mostly change of character or a break in market structure. So this was the previous higher high. The market retraces, break above it. It's now telling us that the big players are in long. So we don't just jump into the trade after noticing a break. Maybe you noticed a break of structure here now, and then you jump into the trade to buy and sell. No, that's wrong. You wait for the market to retrace back into the very level that was responsible for the break of structure. Please pay attention to this now. When a break of structure occurs, or a change in market structure or a reversal occurs, there is always a level, there is always a zone that is basically responsible for that break, for that move, that is responsible for the start of the push. That level is like the genesis of the impulse. We also call that level the candle that brought in momentum. For those people that trade engulfing pattern, the candle that brought in momentum. Now, it is that level or that zone that is being referred to as order block. Are you getting me? It is the level that is being referred to as order block. And for the order block to be considered valid, it must have an imbalance. So let's go quickly go to the concept of imbalance, and let's look at that. Let me wipe this off. Just give me a minute. Let me just remove this one. Let me. Okay, so that brings us to imbalance. So let's look at imbalance. Now, when you have the market do something like this, let me say this is a candle. This is the week. This is the week. And then you have another candle this way. This is the week. And this is the week. And you see this, you notice this visible difference that the weeks did not meet. Just pay attention to what I'm doing. You notice this difference that the weeks of the candle did not meet. And another candle started here likewise. Okay. And another candle opened up around here. This difference in price that these 2 weeks did not meet, this is what we make reference to as imbalance or inefficiency. So this is what we make reference to as imbalance or inefficiency. It simply means that this level was poorly traded. This level was poorly traded. And if this thing occurred in something like the 15 minutes, it means for this candle to continue the move, before that move, this is actually a bullish move. Let's take, for example, before this move we continue, the market at least will come to close this zone now that we are having here. Let me shift this here now. Let me say this zone now that we are having here, where the candle wick did not meet, the market is coming back. The market is coming back to fill this zone. At least 50% of the imbalance must be filled out. Why? This zone, this level is been poorly traded. As a result of too much order in the market, the market quickly pushed up. It's quickly pushed up. So if you are actually followed what I was actually saying or posting on the Telegram channel, where on the mentorship Telegram channel, you could remember what I said on Wednesday. Okay, let me create this week range. This is what we had this week. Let me remove this. Okay, it should be Monday, Tuesday, Wednesday, Thursday, Friday. Okay, that's right. Around on Tuesday, if you followed what I posted, I said on Tuesday, I said there was a break. There was a change of flow that when I said that it boost as actually a short-term buy. I spoke about a short-term buy that the bulls stepped in. Now look at what happened. Let me show you what happened. If you go to the 15 minutes, you will see it clearly. This let me take us to the 15 minutes. This was the 15 minutes. This was Monday. This was on Tuesday. Let me go this way. You see where the market was going down, and this was a break. This was a reversal, a change of character. If you want to see it clearly, use the line chart. The line chart factors in only the closing price. Now look at this. Went up, came down, lower low, lower high, lower low, sorry, lower low, lower high, yes, lower low, lower high, lower low, and the market reverses. Now there is an imbalance here. This level is poorly traded. And that was when I sent a message into the group chat. I said, there is a change in order flow, but it's going to be a short-term buy. I could remember, okay, yeah, someone was asking me, no, not on this very, on another students who I was actually taking on, who I'm taking up on mentorship likewise, was asking me, why was I not selling? So I will not go into that. You have to go through it in one of the videos I'll post. If you watch, look at what happened now. This candle wick did not meet with this candle wick. So I had to mark it out. And when I marked it out, I used the gum box to measure out 50% of this imbalance. And luckily, I got a sniper entry on it on Wednesday. That should be Wednesday morning. Yeah, Wednesday. On Wednesday, I had a very sharp move. So the sniper entry. So at exactly 50% of the imbalance, because that's why if you watch what I said when I was starting the class, I said the market will always come back to at least 50% of the imbalance. So the market quickly retraced back and filled in at least, you see this gap here? Watch the gap between this candle wick and this candle wick. It did not move. It did not balance. That's an imbalance. If you take a look here now, this is quite an, look at this candle. This is an engulfing pattern. This bull candle engulf this bear candle. But if you watch here, this wick of this candle, followed by the next two intermediate candles, they did not meet, is equally an imbalance. Now, the moment you begin to spot an imbalance in the market, those imbalances serve as magnets. I will still take us on this imbalance. I'm just trying to build a foundation for it. I will take us on it tomorrow on a with numerous examples. Now, how do I take my trade? Having considered market structure, the first thing I'll ask myself is this. Number one thing, who is in charge? The bulls or the bears? What's the order flow like? If I have ascertained who is in charge, what's the order flow? The next thing I'll ask myself, where did this move originated from? Now, if you watch what happened here, this was, let me mark this out. This was where the market changed character. And if you watch, if you stretch this thing out now, it was a very nice sniper entry. I don't think I had them up to 5 pips drawdown. So, and it was exactly at 50%, because I told you I used the gun box 50%. So I was tagged into the trade at exactly 50%, factoring in the spread on Euro USD. So we'll still get to those things. So I got in here. If you watch, look at this was the lower high. Look at where the market changed character. There was a break in market structure, meaning the bull stepped in. So since the bull stepped in here, the first thing I had to do is I had to mark out the level that inspired the move. Are you getting it? Now, take note of everything I'm saying. Number one, you take note of the market structure. After the market structure, you will now look for the zone, the origin of that push that changed structure or that broke structure. And the origin of the push, okay. Okay, yeah, I'll get back to that. So my stop loss was actually below the zone that originated the move. Yes, I think I used 15 or 18 pips stop loss. But my drawdown, I was tagged in very early. I had less than 5 pip drawdown, and the market quickly started responding. So look at how to do it. The first thing you have to do is you identify the market structure. When you've identified the market structure, you have to wait for a continuation of the structure or a change of character. When you have spotted a continuation of the structure or a change of character, the next thing you have to ask yourself is, which zone which level did this push started from? Either the push that broke structure or the push that changed structure. Maybe either from bullish to bears, from bulls to bears, or the push that continued the structure. Now, where the push started was here at this very point. Now, second thing I'll ask myself now, this is the origin of this push is what we refer to as the order block. Where that massive buy started from, that is the order block. So having spotted the order block, the next thing I'll have to ask myself is, the zone where this push started from, does it contain an imbalance? Because imbalance is the only proof that momentum came into that zone, that the order was so massive that the market could not efficiently trade the level and the market zoomed up. Are you getting me? So what are we going to be doing? We'll be waiting for now the market to come back to trade those poorly and inefficiently traded level. Those poorly and inefficiently traded level, they are referred to as the imbalance. So they are always like an attraction to price. They will attract price back. That is where the move come in. It is being referred to as smart money. What does smart money do? Smart money, they don't start a move, but they only interpret or follow the footprint of the big players. So 3 elements to smart money is, number one, you notice the market structure. After, when you are done confirming the market structure, you look for the order block, the zone where the move started from. Having identified the zone where the move started from, the third thing you will check for it is, does that zone contain an imbalance or inefficiency? That is the only proof that that zone we hold. If, let me take, for example, a zone like this now. Take a look at this now. I can't trade this type of zone. You know why? Now, remember I said something. If this thing happens on the 15 minutes, you should be expecting a continuation. Now, let me show you something here. This was where the break, okay? Just pay a little attention. Let me, okay? This is where the change of character occurred. This is where the change of character occurred. Can you see it? Now, since the change of character occurred here, we broke below this low, meaning the bear just stepped in. If I was trading the 15 minutes, I'm showing you what I would do. I'll move down to the 5 minutes. We're here to get a time frame analysis. What's time frame analysis? I'll move down to the 5 minutes. Okay. Oh, it's very clear on the 5 minutes. Now, watch this. This was higher high, higher low. No, this higher high, higher high, higher low. But since this move here, this is the latest low that sponsored this high. So our concern now will be here. Are you getting me? Our concern now will be here. So something sensitive happened. The market broke below this our low here, meaning there's a change in market structure, a change of character. The market from bullish suddenly turned bearish. Two things I will look for in this market. I will ask myself, which level was actually responsible for the breaking of this low here? If you've actually followed what I've said so far, you can see is this level here. Are you getting me? You will notice that it is this level here. Now, the next thing I will ask myself is, does that level contain an imbalance? Yes, it does. What do? I will tag myself. I will look for the imbalance. So now watch. Wait, let me just shift this. Let me remove this. This is my block. So now, if you watch, this was the wick. It did not touch with the following candle. So what do I have to do? Look at it. The wick did not touch. But if you watch this candle, look at this wick, it touched, followed by this one, it touched, followed by this one. The wicks were touching. But this candle here now did not meet with this one. The wick of this candle in the consecutive order, 1, 2, 3, at least their wick should touch. But if you watch this one and this one, their wick didn't touch. So it's an imbalance. So I will use my Gambox. Gambox is a charting listing on the trading view. I'll use my Gambox to look for 50% off the imbalance. And if you watch, the market tagged me. I got tagged in. I did not trade this. I didn't. Yes, I did not trade this. But if I had traded this at the 50% off the imbalance, I will be in the trade. So look at this is exactly 50% of the imbalance. I enter the same trade. Now, if you come here now, if you come to this one, this is the imbalance. If you go to the line chart, it will be so visible. Look at it here. Look at it. This is the other block. And I will use the Gambox to measure out 50% of the imbalance. And at exactly 50% of imbalance, at least, if this zone will hold, the market is only coming back into this. The market sometimes will not necessarily enter this zone. That's why my stop loss is always below the zone. Sometimes it will move as far as tapping into the zone. So what do I have to do? I have to place my stop loss below the zone, meaning if the market drops below here, it means this move was not valid. And I will accept the stop loss and I'll get out. But to show you that it's a valid move, that inefficiently traded area, the moment the market gets there, zeroes up or rounds up the move, it fires up. So let me continue with this scenario here. Please just take a look. Remember, this week or this week did not meet with the next week, and there is a very big space. Another way to spot it is you look for a very massive engulfing candle. Now look at this candle here now. You see this candle wick did not meet with this one, meaning this is a very strong inefficiency. What will the market do? The market will surely come back to make sure that those 2 weeks they meet. Look at this now. Mark this candle wick now. Mark it. This candle wick met here. Factor in the spread. They met. They met. Please just look at it. If you pull this wick down now, you see this wick. They did not meet here, but market will go back to close the gap. The market went back to close the gap. Now, take a look at it now. Let's pull it up. This wick did not meet with this wick, but the market will equally come back to close the gap. Have you seen it? So now watch. The market came back to close the gap. And once that gap is closed, it means they have closed the door. They will continue. It's just like you. Maybe you were traveling and you left the door to your house open. Hey, having moved few miles or kilometers, say, hey, I left my door open. I left my door open. You will run back, you will close the door, and you continue the journey. That's the best picture I can use to show you this. So the moment you spotted a, if you can interpret structure very well, market structure, please backtest everything I'm saying here. Backtest everything I'm saying here. If you, let me draw that again. This is it. Something like this. Okay. And you have something like this. Let me see. This way. This way. Okay. Now, this is the imbalance, the point where these 2 weeks did not meet. This is the imbalance. The market, even no, and if this move will be valid, the market will surely come back to close this week. If this thing happens on the 15 minutes, means before the end of that day. If it happens during London, it will close it it will close it in New York. If it happens at the open of New York before the close of London that same day, it will close it to continue the move. So it's a very, very simplistic approach. So I will stop in at this very point. Take note, market structure. If you've identified what the order flow is using market structure, the next thing you have to look at is the zone that started the move, the zone which served as the start of the push. And then a very easy way to identify the start of the push can be an engulfing pattern, an engulfing candle. That start of the push can be referred to as the genesis of the impulse or the candle that brought in momentum. Now, when you've identified that zone which is serving as the order block, the next thing you have to look for in that zone that will validate that impulse is an imbalance. If that zone does not contain an imbalance, don't enter it. If you enter it, that's no more a smart money entry. Well, smart money entry simply means just you are trying to scale through the footprints of the big players. You cannot direct the market. So you wait for where they had leftovers, and you trade their leftovers. And as you are trading their leftovers, you'll be targeting maybe the next zone or other block that is, or you'll be targeting the next zone or the next order block that contains mitigation. That is yet to be mitigated. Now, if this level here, let me say, if this level here now, remember what I said about mitigation and why a mitigated zone and a non-mitigated zone. If your entry started from this very imbalance here now, you should be targeting a level or a zone that is unmitigated. The moment you get to that zone that is unmitigated, you take your profits. Why? That is how smart money play. Smart money, they try to enter in a zone that contains an imbalance, and they exit at the next unmitigated zone, because the moment price steps into an unmitigated zone, it has been mitigated. So that move may reverse. Are you getting it? So I think to the best of my knowledge, I've done maybe quite some justice to this. At this point, I would love to be calling it a day because I want to face something else. I have another class tomorrow morning with some persons. So that's quite stressful. That's what my schedule looks like. So I don't really know one or two things you have to say. If you have your question, reserve it. Get it across to me through the Telegram channel, the Telegram group chat, and I will actually attend to it one after the other. So a very quick recap of everything we've said so far for today. Market structure helps you to identify order flow, who is in control, who is in charge. Having identified who is in control, who is in charge, you look for where the move started, which is the zone where strength lies, and that will serve as your order block. Having identified the zone where strength lies or where strength started from, you have to look for an imbalance, a poorly or inefficiently traded area. Believing that market will come back to close their door before continuing the move. And a very good analogy I use to drive home the point is just like you were starting out on a journey, or you've left your house already, and you just remember that you've not closed the door. The first thing that is needful of you is to go home, close that door, and continue your journey. and simple as that. So at this point, I'm very grateful. Thanks for your time. Thanks for everything. Thanks for the attention paid. And wishing you all the best. We're going to be meeting tomorrow likewise as we'll trash up some other facts. Thank you.